Hey, how's it going, everyone? My name is Amos, and you've heard me time and time again. I think most people are better off just investing into VTI or even VU and calling it a day. And on paper, it probably makes sense to you, but it doesn't sit right with you because maybe you're an ethical investor or you just want to invest into the winning industries while avoiding the losers. Or you wanted to watch this video because you're curious about the results, or the burger on the bottom right made you hungry. Well, let's go ahead and figure that out today. What is the best sector to invest in based on past performance? But before we do anything crazy, let's establish what the heck a sector even is. A sector is what you see on your screen right now, is a broad category of similar companies, whereas industry is a specific type of business within a sector. Let me give you an example. One sector is the energy world, and an industry within energy can be the renewable energy modalities like wind and solar or the big oil machine. So you could work in the energy sector, and the specific industry could be the guy who installs solar panels on the rooftops of rich folks down in Florida. But I mean, to be honest with you, we could just use it interchangeably. And to help us investigate and determine the rate of return for the different sectors, we're going to refer to ETFs. So instead of individual measurements of like 100 different energy companies, we're just going to look at an index fund that has all of the different energy options included. So think of an index fund as one stock that has like 100 to 3,000 companies within it. The index fund will give us a general pulse and health of an industry. So, sticking with the energy example, the first one we're going to be looking at is VDE. It's an index fund that covers the energy sector, and their portfolio has about 110 different companies that all, in one way or another, are in the energy sector. So what you see on the right side of your screen are the top 10 holdings. So when you buy into one share of VDE, you buy into ExxonMobil, Chevron, ConocoPhillips, and the list goes on. And they're currently trading for about $129, $130 a share, depending on the day. The dividend yield is a respectable 3%. Now, I'm going to tell you this right now. I'm not a big fan of the energy market and business, but I have heard very nice things about their workplace culture and compensation. Unless, of course, you're an oil rigger getting swallowed up by a storm and you're away from your family half the year, then you probably have a bad experience. But if you work in their corporate office, I heard it's not a bad time. And as a benchmark, sometimes we're going to refer to the S&P 500, and other times, to expedite the video, we're going to compare the sectors against one another to see their overall performance. By doing so, it's going to help us to see the bigger picture and make conclusions based on data. But before we go any further, if you've been following this channel for a while, then you know that I'm knees deep into becoming a history nerd right now. The transformation is happening day by day. And these days, I've been going down the rabbit hole of researching and learning about the American pioneer days with the Mexicans, the Spanish, the indigenous tribes, and Texans all interacting with one another. And I'm going to tell you, it's been a wild ride. Apparently, what you see on your screen right now, the Comanches were some badass dudes on mounted warfare. When the Comanches were mounted on their Mustang ponies, nobody could touch them. Even the Spanish ended up giving up their American endeavors and dreams because the Comanches just kept kicking them in the balls. But anyways, growing up, I always thought Native American names were prestigious and very spiritual, right? Like Brave Eagle, or Loyal Elk, or Crazy Horse and Sitting Bull. But come to find out, the Comanches, which were the strongest war-fighting tribe in Native American history, they used to give each other names like Sweaty Nipples, Hairy Buffalo Butthole, Ugly Face but Strong Hands, or names like Saggy Tits. I am not exaggerating. So even though the Comanches were vicious in war, deep down, they had an intense sense of humor. Joking and teasing each other were a part of their culture. Can you imagine if I walked around with a nickname of Soggy Burger Buns or Small French Fry Dick? Actually, to be honest, I would love it. That's pretty amazing. But anyways, let's get back into the video. So when we look at VDE and the energy sector, if we would have invested $10,000 back in January of 2015 and reinvested the dividends to buy more shares, then in 10 years, it would have been $15,600. On the other hand, that same 10 grand would have turned into $31,000 with VU, aka the S&P 500. And why are we comparing the energy sector to the S&P 500 500? Because I think the S&P 500 is an interesting benchmark. Not only is it referred to as the market, but it contains a little bit of every sector we are looking at today. That means the S&P 500 has winners and losers within it. So I think this experiment will be cool to see which sectors are the winners and then also the losers that are weighing the S&P 500 down. Much like the toxic people that are in your life. Did you know there are some people that will genuinely breathe negativity, hatred, and anger and even influence your mood and outlook? All I'm trying to say is just be careful out here. There's some crazy people walking around. The same type of people that will put a white guy as a cornerback on a football team instead of training him to be the kicker or quarterback. Speaking of which, I used to be the running back and punter for my football team. And by the way, before we move on, I wanted to call out that for energy, if you invested that $10,000 back in 2015, it would have grown at a rate of 4.8% year over year, known as the CAGR. The compound annual growth rate is the performance indicator once you reinvest the gains and dividends back into your initial investment and letting it ride and doing that again and again year over year. And for the S&P 500, that was 12.8% year over year. Okay, I hear you. Less yapping and more data and numbers. What you see on your screen right now is a breakdown of the yearly performance, and I would say it looks like the energy sector is a lot more volatile than the market in general. Energy is reflected by the dark blue, and the S&P 500 is reflected by the lime, teal, turquoise color. And I say that because when the energy sector is down, they're down really bad, like back in 2015, 2018, 2020. And when they're up, they're really up, like back in 2021. Just look at the difference. The energy sector went up by 62%, and the S&P 500 went up by 31% during their best years in the past 10 years. And look at the difference in 2022. When the energy sector was up by 62%, the S&P 500 was down by about 18%. And then now we're looking at a visual representation of that $10,000 investment transforming over the years. I think between you and me, if you invested into energy back in 2015, you would have been absolutely pissed off in 2020 because your money would have gone from 10 grand down to about 4,600. Not a good time. But if you had the stomach to write it out, you would have been very happy by this year because it would have rebounded from 4,500 up to about $15,000. On the other hand, if you had invested into the S&P 500 back in 2015, you would have been sleeping pretty soundly at night. Because the market, although there were some dips like during the pandemic and 2022, time and time again, the market just goes up. The next sector is going to be the real estate world, represented by the index fund known as VNQ. And the dividend yield is currently sitting at 4.25%, which is pretty juicy. But I do want to call this out. The dividend that you get every quarter is not going to be qualified, meaning it's going to be taxed at your income tax rate. And when we look at their top 10 holdings, we see all of the REIT favorites, such as American Tower Corp, Welltower, Simon Property Group. They do malls and shopping centers, Realty Income Corporation, and Prologis. I think it's that warehouse logistics company. And they're currently trading just shy of $90 a share. The same parameters as before with the energy sector, $10,000 invested into VNQ, aka the real estate sector back in 2015, would have transformed to $15,000 in 10 years. The year over year rate of return would have been 4.4%. And as I look at the year over year performance, I think inflation just really ruined the real estate world. But this is speculation, but I think once the interest rates come back down to earth, by the end of this year and going into next year, I think real estate should rebound like we saw back in 2021. It's a hot take, but it's just my opinion. And when we look at the growth of that 10 grand invested into real estate, it stayed pretty much flat until about a couple years ago. That 10 grand would have stayed around that 10 to 12 grand region until 2022. Now, the next one is the finance sector, index fund VFQ. VFH covers almost every company that has business related to money. I'm talking about banks, the payment processing apps, the credit rating bureaus. The dividend yield for this index fund is currently sitting at 1.9%. And on the right side of your screen are the top 10 holdings. We see MasterCard, Visa, JP Morgan Chase, Goldman Sachs, S&P Global, and American Express. And we're going to be comparing finance to the technology sector, which is represented by the index fund VGT. And VGT pretty much has all of the tech companies that you can think of on the right side of your screen of the top 10 holdings. It has Microsoft, Apple, Nvidia, Broadcom, AMD, and the dividend yield is currently sitting at 0.6%. Now, this is the first one where we're not comparing the sector to the benchmark of the S&P 500. Instead, we're comparing them against each other. So $10,000 invested into finance back in 2015 would have generated a pretty awesome rate of return, right? $24,500 from that initial 10 grand. Year over year, your money would have grown at a rate of 9.9%. The finance CAGR is pretty respectable with a capital R. But my goodness gracious, my friend, look at the right side of your screen. When we look at the tech sector's numbers, 10 grand would have transformed into $60,000. The CAGR is just shy of 21%. Can you imagine your money invested growing 21% year over year for 10 years? When we look at the year over year breakdown, the tech sector, which is reflected by the teal turquoise color, makes the finance one, which is represented by the dark blue, just look like doo-doo. But in reality, the finance sector did pretty amazing for the past 10 years. It's just that the tech companies have been on a bull run. Because I'll tell you what, if we compare the finance sector to real estate, the finance would have looked like what tech looks like right now. And when I look at the chart of the 10 grand just growing, it's not even funny because it makes me regret my decisions of not going all in into Apple, Microsoft, and Google when I had the chance back in 2015. But you know, as they say, hindsight is 2020. The next sector we will be looking at will be the utilities, portrayed by the index fund VPU. VPU sounds like the name of a college or something, and it's a pretty straightforward sector. These are companies that help keep your lights on or for your gas stove to work the way it should. They supply your utilities and you pay these utility companies. And utilities, fun fact, used to be the safe and steady sector until recently. They just got absolutely demolished by the high interest rate environment because you usually invested into utilities for their dividend. Because historically, the utility companies used to give dividends that were as high as real estate companies, but the dividends were qualified, unlike REITs. So when we look at the sector as a whole, the dividend yield is just shy of 3.3%. And these are the top 10 holdings. And we will be comparing the utility sector to the healthcare world, which is illustrated by the index fund VHT. These are companies in the business of making pharmaceutical drugs, medical devices, and drugstore products. The dividend yield for the sector is 1.3%. Here are the top 10 holdings. We got Eli Lilly, United Health, Johnson & Johnson, Abbott Laboratories, Danaher, Amgen, Pfizer, and the list goes on and on. When we look at the growth of $10,000 in the same timeline as the other examples, the healthcare sector did a lot better than the utilities sector. The 10 grand would have grown to $24,000 in the healthcare world, and with utilities, it would have been just shy of $20,000. And when we look at the CAGR, I think both did pretty well. 7.3% is pretty respectable, but 9.7%, that's what we're talking. In my opinion, anytime you can get a rate of return that's around 10% year over year, that's when you're doing pretty well. And so healthcare just missed the mark, but it's closer than utilities. Utilities is reflected by the dark blue color, and healthcare is reflected by the teal, the turquoise. What do you call this? I don't know what this color palette is called. And on that note, I remember last year when utilities were going through a massive sell-off, it made me feel silly because I've been a long-term investor of Dominion Energy. This is before I had my fundamentals down and what to look for in dividend growth companies, which is kind of funny because I invested into Dominion because they were my utility company at the time. And I was like, hey, if I'm going to be paying the bills to Dominion every month, then I want to get a dividend right back from them every 3 months. Really silly investing thesis. I bought into Dominion Energy a really long time ago and I just never sold out of it. I just hang on to them because of the dividend. And I think going forward, the utilities sector is going to be okay. Strangely enough, a handful of pharmaceutical companies have been receiving the same ugly guy treatment because their patents are expiring. So, not trying to be too obvious here, but Pfizer has been going through it. And when we look at the chart of the 10 grand growing, I would say that utilities and the healthcare sector, they took turns outperforming one another up until the pandemic. And as we all know, during and after the pandemic, the healthcare industry just flourished. Next up, we have the industrials sector represented by index fund VIS. The industrials sector is everything to do with transportation and manufacturing of planes, ships, tractors, trucks, and tanks. But this also includes building products, waste management, engineering, and defense contractors. The dividend yield is sitting at 1.3%, and on the right side of your screen are the top 10 holdings, and it's not reflected here, but 3M is also inside of VIS. And we will be comparing the industrials sector to the materials sector. I feel like they're cousins to me. The materials sector index fund is called VA, which I feel is like a play on words for raw, but anyways, VAW. And it's made up of companies in the commodities business. Think about like chemicals, steel, minerals, paper products, and forest goods. I'm not really bullish on this sector, but I do think it's important for the economy. The dividend yield is sitting just shy of 1.7%. And at this point, you already know what's happening. We're looking at the growth of $10,000 in the span of 10 years. And this is pretty surprising results because they both did a lot better than I expected. With the industrials, aka the machinery, that 10 grand would have transformed into $25,000. The annualized CAGR would have been 10.4%. Hey, they did really well. And on the other hand, the materials sector, well, that 10 grand would have transformed into $21,000. The annualized CAGR would have been 8.2%. Having your money grow by 8% or 10%, pretty good. And looking at the year over year, I can't help but notice that every few years or so, it seems like both of the sectors go into the red. But that's okay because when you average it out year over year, for industrials, it was sitting at 10%. And for materials, your money would have grown by 8%. But it is kind of weird that they go down every few years or so. And on this graph, we can see as of recently, the industrial sector has been outperforming their cousin from West Virginia by a significant amount. My voice is starting to get a little sore, but the next sector we are looking at, I'm going to be honest with you, it used to confuse me initially when I started studying the stock market a while ago. It's the consumer discretionary sector, represented by the index fund VCR. Yes, those tapes we used to put in and watch TV and cartoon shows. I always got consumer discretionary and consumer staples mixed up. So let me explain it in a way where it's really easy to understand. Think of consumer discretionary companies as wants and not needs. So these are products and services that people want but are not necessary to sustain life, such as entertainment, restaurants, luxury items, brand name clothing like Lululemon, cars, and gadgets. When tough times hit, people will cut back their spending on discretionary services and products first and foremost as a general rule of nipple. On the other hand, consumer staples are stuff that we need to survive, like food, water, beverages, shampoo, toothpaste, and household items. But anyways, for the consumer discretionary index fund VCR, the top 10 holdings are reflected by Home Depot, McDonald's, Nike, Chipotle, Tesla. And on the other side, the consumer staples sector is represented by the index fund VDC. And it's made up of companies that people need despite macroeconomic conditions. The dividend yield for VDC is sitting at 2.5%. And when you look at the right side of your screen, I thought the top 10 holdings pretty interesting because I didn't think tobacco was necessary to sustain life. But I guess if you're addicted to nicotine, it's just as important as water and food. And it's represented by Philip Morris and Altria. And when we look at the $10,000 experiment, it does not surprise me at all. Of course, you're going to see bigger numbers with the discretionary items because the profit margins are a lot higher than the staples counterpart. So the left side of your screen is discretionary, represented by wants. The right side of your screen is consumer staples, represented by needs, necessity, sustainment of life. So reflecting on discretionary spending, I think about luxury handbags. It costs a high-end company about $58 for labor and supplies and marketing and everything else that goes into it. And they'll sell that exact same handbag for around $10,000 because of a certain logo or brand. I know that's an extreme example, but that's the type of profit margins that you can see with a discretionary product or service. But on the other hand, when we think about Walmart or Procter and Gamble, they have tiny, very slow single digit profit margins, and they make good money because of volume rather than marked up prices, if that makes sense. And when I was looking at the year over year breakdown between VCR and VDC, my jaw dropped to my man titties because when you look at 2022, that type of decline is what makes men go bald prematurely. My goodness gracious. In 2022, the discretionary spending went down by about, what is this? Negative 35%. Whereas for consumer staples during their worst year, which was, back in 2018, well, they went down by negative 7%. But despite that huge drop in 2022, the consumer discretionary sector slaps big booties. It's truly eye-opening to see the results. Ever since the pandemic, the discretionary sector, represented by VCR, has just been on a roar. And now we are going to rank the sectors based on their CAGR for the past 10 years. So we're going to rank them objectively based on the year-over-year rate of return. So in first place, we have technology with a rate of return of 21% year-over-year. And here is why I always advocate and support VU. Investing into the S&P 500, aka the market, because second place, it was them at 12.8%. It beat out every other sector, besides tech, of course. And when we look at the bottom of the rankings, it makes a lot of sense because the high interest environment has really hammered the sectors that are known for their dividend payments. So the real estate industry, energy, and utilities. All three of them have just been... Actually, I take that back. Utilities should not be a part of that conversation. I think just energy and real estate has just been getting hammered in the past 10 years or so because utilities and consumer staples are pretty much the same at 7%. It's interesting to see the results because at one point in time, the energy sector was where the money was at. It was the king of the stock market. I'm talking about way back in the day, and now they're not. The thing is, once a sector becomes very mature, the growth slows down as innovation is decreased for the most part. Likewise, when we look at finance, they're sitting at 9.9%, which is pretty respectable. But back in the day, people used to pile their money into financial companies because they wanted to invest into the institutions that generated money with money. But after the Great Recession, the finance sector has taken a pretty big hit, except for fintech and payment processing companies. So I'm a pretty naturally curious George type of guy. So I wanted to look at the total return for the past 10 years for our top two winners. And check this out. With tech, represented by the index fund VGT, the total return would have been 530%. My goodness gracious. A 530% total return is just absolutely bonkers. On the other hand, with the S&P 500, your money would have grown by 230% during the same time period of 10 years. And I think that's because energy and real estate really slow down the S&P 500's potential, like having the sudden urge to go number 2 during a marathon or during one of your morning runs. So I don't know about you, but that was a pretty interesting video. I had a lot of fun making this because I knew that tech was a winning sector, but I didn't know that tech has been putting the whole team on his back like LeBron James and Team USA. Based on what I have seen on social media, the almost 40-year-old LeBron James is doing work for the men's basketball teams. Same with Stephen Curry. So when we think about the market for the next 20 to 30 years, what do you think will be the biggest boom? the kings of the market going forward in 2030 and 2040. My prediction is that the tech industry with cybersecurity and AI will remain the winners, is what I see right now. Because apparently Wall Street loves Nvidia, Microsoft, and chip companies. I'm not talking about PepsiCo, but the little chips that are inside of our phones and computers. I also think the manufacturing sector has room for growth if, and this is a big if they pioneer making the robots that are going to eventually replace human labor. I'm also pretty bullish on the streaming platforms like Amazon's Twitch, Google's YouTube, and Netflix. Anyways, based on how much I enjoyed making this video, I'm going to be doing a part 2 so that we can examine and compare specific industries against one another. More specifically, the AI industry, biotech, renewable green energy, ed tech, and the list goes on and on. Because I think when we break down the tech sector into specific industries or even healthcare, I think we're going to see where the real growth and potential is going to be going forward. So it should be interesting. Anyways, until next time, I hope you stay safe and I love you. This is Amos signing out. See you guys.